On today's hot sheet, I'm discussing the new home sales report for January, a temporary FHA waiver to deregulate building, Apple's $500 million plus investment in the US, what that'll mean for housing, and the weekly unemployment report just released today. Today is Thursday, February 27, 2025. I am Byron Lazine, and the hot sheet starts now. Welcome into the hot sheet. Let me know in the live chat which market you are tuning in from. This is the last hot sheet of the week. It's Monday through Thursday every single week. If you're new to this show, live at 9:30 on the East, 6:30 on the West. It's the only 24-hour look back on the housing market for housing professionals, investors, agents, brokers, team leaders, and the like. If you are new, make sure you go down and hit subscribe. Almost 50% or more of the viewers of this show are not yet subscribed. Hit the subscribe button down below, hit the notification bell so that you don't miss a hot sheet any single day that it is open, Monday through Thursday when markets are open. So let's jump in here. We've got a whole bunch to go through today. There's been a lot of data, it seems like, lately. I don't know if it's just like beginning of the year stuff, new administration stuff, housing kind of being in the balance of the fight against inflation, all of that. I don't know. There's just a lot going on. We're going to start with new residential sales. Then we'll get into this FHA deregulation measure. So maybe we're starting to see some of this Trump administration, impact on making housing affordable. I don't know. We'll get into that. Apple having an impact now on housing with their investment. And then obviously the unemployment data here for today. All right, starting with new residential sales. January release is out. New residential sales for January of this past month, 657,000. This is on a seasonally adjusted annual rate. This first number, 657,000 new houses sold, seasonally adjusted annual rate. Make sure to clarify that. New houses for sale, just only seasonally adjusted on this one, 495,000. We're seeing now across the board, new construction builders. Ivy Zellman, we broke down some of her thoughts yesterday on builders and building stocks, some of these mega national home builder stocks. She's not very bullish on them, that's for sure. Toll Brothers would be the only one she would even consider purchasing right now, in her words. And it's because of this new houses for sale, this inventory that is piling up right now in the new construction sector. Median sale price for new residential sales was $446,300. And listen, maybe $446,300 doesn't sound like a lot to you, but to many Americans who want to experience home ownership, 446,000 is a lot. And so if the existing home sale in that particular market is trending at 390 or 395, if 446 is what your market reflects for new construction, might be higher, might be a lot higher. But if the existing home sales are less, then they're going to be leaning more towards that. They get the same square footage on existing. They might give up some of that shine if it's really coming down to, affordability. Here's something to think about on this, that I've actually been, I've been certainly a proponent. If you've been following the hot sheet for quite some time, I'm a massive proponent of seeing our inventory get back to a level that we've seen in normal markets. Like, yeah, I get it. There's parts of, Florida, certainly inventory is back versus pre-pandemic levels, but the majority of the country is not back to pre-pandemic levels in terms of inventory, in terms of active inventory on existing home sales, single family homes. And so, we want to see inventory come back because that's going to stabilize prices and some of the appreciation that we've seen so far. But how much inventory maybe do we want? And I'm starting to maybe even look at this a little bit differently, because if new home construction is up over 9 months of inventory, And here's a tweet from Lance Lambert on this. Okay. Home builders unsold completed inventory reaches highest level since 2029. Okay. So builders are facing pricing pressure. Florida and Texas markets really driving the bulk of this. So there's that context there. But if we, oh, I'm sorry, press something there. Very, very touchy here today, X. There we go. Look at this. Highest level of completed unsold homes since July of 2009. And this number has sharply increased here for home builders. Now, we're nowhere near these levels that we experienced in 06 and 07 and 08. Nowhere near those levels. But we are on a sharp increase on number of unsold completed homes for sale. So if we were at normal levels of existing homes on the market, we might see significant price pressure that almost might be a little alarming, a little concerning. So it's like there's a balance there with the existing. Maybe it is. I'm just throwing this out there as a brain twist. Maybe it is to our benefit to not see the active inventory on existing home sales, increase too rapidly. Because what would that do to price? We want price stability. 10 and 15% home price appreciation is exacerbating the issue of affordability. But on the flip, nobody wants to have a conversation about homes dropping 10+%. Not that we've seen that a lot in obviously the history here, but it's not a situation that we want to be faced with in the housing market with all of the other issues that we have. And this is what we're up against. Look at this housing affordability. The U.S. annual income needed to purchase the typical U.S. household right now is at $92,000. Back in 2020, it was $51,000. So household income needed to afford the financed purchase of a typical valued home. Okay. And these new construction homes that we're seeing here, going back to this Census Bureau report released today, these new construction homes are not the typical home. Okay. 446 is above typical across the country. Now, where do these numbers sit related to last month and related to last year? This number here of 657,000 is 10.5% below December rate of 734,000 on new home sales. It's 1.1% below the January 2024 estimate of 664. New home sales cooling considerably. Sales price, the median sale price of new houses sold in January 25 was the 446,000. The average sale price was 510,000. Again, above what a typical home and what a typical buyer can afford. Why these months of inventory now are 9+ months. And in some markets, Florida, that's going to be higher, okay, than 9 months at the current sales rate. Okay, so inventory here becoming a little bit of a concern for the builders. And we're seeing this now on the sales start to have a real decline. Expect more of that in the future. And it's one of the reasons why, if you go back and do the replay for yesterday's hot sheet, if you missed it, Ivy Zellman, one of the most respected analysts in the housing market, not bullish on new construction stocks and not bullish on the builder sector overall. She wasn't really bullish on any sector, but as it relates to builders, certainly not bullish. One of the things that might help builders, might help affordability on homes, is the FHFA temporary waiver now on new single family flood elevation requirements. Of course, this is going to impact flood zones in the coastal communities, but the FHA, Federal Housing Administration, now maybe starting to show their cards of what the new administration, what are the new policies, that deregulation we've heard so much about, what that is going to mean and what it means for builders. They've announced a temporary waiver for new construction in special flood hazard areas as part of the federal flood risk management standard. Okay. So these requirements issued by the Department of Housing and Urban Development for single family construction took effect on January 1st, 2025. The waiver means that new elevation standard requiring the lowest floor of new construction to be at least 2 feet above the base flood elevation has been rescinded. It's like what, anyone that lives in a flood zone right now or works in coastal communities is like, wow, they rescinded that. This waiver applies to FHA insured mortgages on new single family construction. Okay, and making this announcement without its partial waiver, the new MPS, minimum property standards, required elevation standard would have limited the land available for development and increased the cost of construction for FHA insured single family properties, thereby contributing to the insufficient supply of new construction housing and rising home prices. Okay, so listen, this is going to be taking place for 1 year from basically today. It's going to take place till February 21st, 2026. It makes building in certain areas more attainable. What are the the question I'd have is what is not mentioned here on the NAHB website on this announcement is what are insurance companies going to say? But what's insurance companies take on this temporary waiver? It's like, okay, you can get the mortgage, but without getting insurance, you can't get a mortgage. So the insurance companies are going to have to play ball here. And is that insurance going to be so expensive that it puts the numbers out of whack for the mortgage? But certainly from a construction standpoint, areas that you can build, this is deregulation, maybe one of the first moves we've seen from the new administration to essentially go ahead and do this. There's more information on HUD.gov on this temporary partial waiver. It's a 4-page document. I'll have that linked up inside of BAMX for the BAMX members. If you're in a coastal community, certainly understanding this. And this is again here, one of the first things we've seen from that January 20th executive order, emergency price relief for American families and defeating the cost of living crisis. This is, this is in line with that. And one of those ways to deregulate building. That's what we've heard a lot. We need to deregulate. Well, a lot of the regulation comes local municipalities. This one here is something that the federal government obviously thought made sense and is enacting now and will be in place for 1 year. And we'll see how that takes shape and see how insurance companies obviously respond to that. But new information, if you're in a flood coastal community, dig into that. Again, available right inside of BAMX. By the way, BAMX members, if you are unsure where to find some of this stuff that we talk about every single day on the hot sheet, just jump right into Classroom tab, go down to hot sheet, click on today. You have everything categorized here on the left by month, most popular charts, all of that. If you click into February, click on today. You've got all of the charts that we're working on today. And then down here at the bottom to grab these PDFs all in one place, and our actual hot sheet show notes, how we make the cake here, segmented out, every single thing that we're talking about here on the hot sheet, right there at your fingertips. So you just go into that Classroom hot sheet, grab it all. You can easily download this stuff, one click of the button here at the top right, and use that in your communications. Join the BAMX community by going to school.com/BAMX. School spelled SKOOL.com/BAMX. All right. Speaking of just great companies like BAM, let's talk about Apple. I mean, that was a little bit of a lame joke right there, but let's do it anyways. What Apple's $500 billion U.S. investment means for real estate, AI, and U.S. jobs. This article is on nowbam.com. Obviously, you can grab that there at any time. So Apple now making its largest investment ever in the U.S. This is a more than $500 billion over the next 4 years, focusing in on AI manufacturing and research and development. The expansion includes 250,000 square foot facility in Houston, a $10 billion boost to its U.S. manufacturing fund, and get this, thousands of new jobs across multiple states. Okay, why did Apple do this? Tim Cook was obviously, an attendee at the inauguration for President Trump. I don't get the sense that because he was at the inauguration, they're old-time golfing buddies. Tim Cook is somebody who has supported, the other side of the aisle openly and with his dollars in the past, attended the inauguration. And I don't think he would invest $500 billion just because they're now becoming close. They meaning Tim Cook, CEO of Apple, and President Trump. There's been a lot of opinions about these tariffs, and these tariffs are going to really increase inflation, and maybe they would if the tariffs were presented or put into place in the wrong way or too aggressively and whatever. But this might be an actual signal of tariffs working, just the threat of them, right? Apple manufacturing is predominantly in China, and maybe they're investing in America to avoid the 10% tariff. Like, I don't know. What Tim Cook says, though, is they're bullish on the future of American innovation, and we're proud to build on our longstanding U.S. investments with this $500 billion commitment to our country's future. A very pro-America comment there from Tim Cook, the Apple CEO, somebody who's obviously been heavily invested in, meaning their company over the years in China specifically, to lower their manufacturing costs. Now all of a sudden, wants to go out and do a $500 billion investment committed to over the next 4 years in the United States. It's 2.9 million jobs that are currently supported, 20,000 new Apple hires in the next 4 years. So 500 billion, 20,000 new Apple hires over the next 4 years right here in the US. And then 24 US factories producing silicone for Apple products. So making a significant stance. And then in the commentary, Tim Cook just going all pro-America. I mean, he went all the way up to the edge of throwing a MAGA hat on there on the comments. Very much pro-future. And this is what this means for different locations in America. It's Michigan, it's Texas, it's California. So it's not just one state. It's Arizona, it's Nevada, it's Iowa, Oregon, it's North Carolina, it's Washington. They're doubling down on U.S. manufacturing. So when you bring in 20,000 new jobs, anybody in a market right now where you're seeing expansion, building, what that means for the future of the real estate market. That means jobs follow. You see new buildings being built that are not just residential, but they're buildings that supply business, manufacturing, whatever the case may be. Right down the road, 10, 15 minutes down the road from me is going to be the first ever owned Tesla maintenance shop. They have plenty of them across the country, but this one's going to be company owned with a showroom included. Okay. It means that for me, if I need something on my Tesla, I don't have to go up to Fort Myers. I can just go right here in Naples. But it also means that, hey, there's going to be somebody maintaining that new building. There's going to be people working in that building. There's jobs. And that's just a very small example in any market. When you bring one of these big companies in, they bring jobs, they bring, ancillary support to that building, to the roadways, to whatever they've created in that environment. 20,000 new jobs is significant for these markets that are impacted. It's particularly these states right here. That's a good thing for the real estate market. Apple's not, I don't get the sense, I'm not an expert on it, but I don't get the sense that Apple's doing, any, minimum wage jobs. They're probably very good paying jobs. Tim Cook now, off of the last comments, doubling down on this all-in American innovation, from doubling our advanced manufacturing fund to building advanced technology in Texas. We're thrilled to expand our support for American manufacturing. We'll keep working with people and companies across this country to help write an extraordinary new chapter in the history of American innovation. Really just, making it known that this is a good thing for the country. I don't know if it's playing into what the new administration wants to hear, but it's something that for us, for real estate, for markets, it's one of those indicators that, yeah, the next couple years could be building up to another real estate super cycle. That's what the JP Morgan analyst said that we covered, earlier in the week. Like, when we look backwards in 2 years, what we may have bumps in the roads, but are we going to be hitting another real estate super cycle? You see more of this, that would suggest that that's going to be the case. Apple's not the only one that's made major moves like this and that have impacted the local community in which those moves were made. Think back to what Mark Wahlberg's done over the last couple of years, developing a Hollywood 2.0 in Las Vegas, shifting entertainment production to Nevada, and that has transformed real estate markets. I know we have some folks in here that are in the Las Vegas market. Las Vegas right now, usually when you have a recovery happening in Florida and Texas like you do, usually Las Vegas is right there with them. It's been the opposite. Vegas has been growing. Price has been appreciating in Vegas. Inventory is not rising like Florida and Texas, and usually Vegas is right there by their side. Inventory is getting more scarce. There's a lot of people moving out of California into Nevada, not just to escape climate, but to find the next wave of where production is happening. In this case, being Hollywood 2.0. Mark Wahlberg himself, if you followed this, and we have a story on this on BAM. You can link out to it from this story. Mark Wahlberg has not only brought Hollywood production to the Vegas area by relocating his personal residence, he's also been investing in restaurants, in gyms and fitness centers. All of these things have created more jobs, more reasons for people to move into Las Vegas. And the most recent development is this Senate Bill 238 introduced into legislature this week. It's one of two bills seeking to expand tax credits for film studio in Southern Nevada. So when we're looking at the FHA making a move on deregulation to make it easier for builders to potentially create a more affordable product in flood zone and coastline, or just create more product and more inventory into the market. The states that are smart about creating an opportunity for more things to be built, are creating like this here, Senate Bill 238 in Nevada, more opportunity for growth. Now, Ruthie says Las Vegas is growing too fast. Ruthie would know. Ruthie is the expert on all things Las Vegas. But that rapid expansion certainly going to push prices up, make inventory hard, put some strain on inventory, but it really is telling the story of a bright future, right? It's not a place where people are leaving. It's not a place that people are concerned about the future. It's a really bright, they're going to have to catch up and do things on inventory and all of that kind of stuff, for sure. But it's telling the story of a bright future. You have a government right now from the federal level who wants to make deals that brings jobs and growth into different American communities. Apple now kind of riding that wave and putting their money right into the U.S. economy at a $500 million investment. And we'll just see how it plays out. Obviously, we'll see what kind of impacts that actually has on the economy. Steve says WrestleMania in Las Vegas this year. WrestleMania, one of the best parts. I've actually been to a WrestleMania. Best parts of my childhood is following every WrestleMania. I'm sure the one in Vegas will be like no other. Anybody that's a wrestling fan out there knows what I'm talking about. All right. What you don't see from the WWE and the wrestling and UFC environment is layoffs. They continue to grow those two businesses. But across the country, we've now seen the highest level of unemployment claims at 242,000 for the week ending February 22nd that we've seen since the first week in January. Slight uptick here now on unemployment. We don't really start to worry about this until you get up over 250,000, but another indication here that the job market is obviously softening, but that potentially the economy is softening as well. Tomorrow, we're going to get PCE on inflation, the Fed's favorite gauge. We saw some data come out, some economic data come out today that suggests, The economy is just not, just not growing at the rate that some would like it to. Again, every day it seems like the data gets a little bit different. But this one in particular here, unemployment being the highest level since the first week of the year, is showing us that, hey, maybe there is something to a little bit of a slowing economy, caution from certainly employers, and now unemployment ticking up. One of the big conversations around unemployment is how this Trump and Doge terminations from the Doge crew is going to impact job cuts. CNBC put some information out here to bring this into perspective. How will this actually affect the economy? Financial strains on the topic there. Affected workers who can't quickly find new jobs may be forced to make ends meet without regular income. Unemployment benefits offer a temporary stopgap, but they replace only a third of the prior wages on average, according to the Labor Department data. And particularly, we're not going to see, if there is really going to be an exodus in DC, we're not going to see this for a few weeks. So that 242,000 increase is not a DC thing. That's not a Maryland, Delaware thing. First of all, it would take 2, 3, 4 weeks potentially for that to even get into the system of people looking for unemployment benefits. And some of those jobs in DC, while they're government paying jobs, they're still obviously, not too many of those workers are going to want to go and just collect a third of prior wages, or what could be even seen as less, with the jobs that they have. And so, they're going to be out there looking. There's obviously, Ruthie's saying it here, there's a lot of job opportunities in the private sector for some of those folks. So this is not what we're not seeing yet, is a influx of unemployment from that area. We're just not seeing it yet. There's obviously conversation, fearful headlines, whatever, that may be the case. We're not seeing it yet. There's a community impact, as laid off workers may spend less at business, such as local coffee, restaurants, daycare facilities. For sure. If you're on unemployment making a third, you're going to spend less, as according to Yale University Budget Lab. Way to go, Yale. There's a psychological factor to mass layoffs too, economists say. Other federal workers fearful for the jobs may pull back on spending and delay big ticket purchases. Businesses with ties to the federal government or the federal workforce and investing due to uncertainty, they'll stop hiring and investing. So it's not recessionary on its own, though. Okay, and this is maybe the most interesting point that CNBC is making. Economists don't expect the job cuts will have a huge impact on the overall U.S. economy. However, though, if about 200,000 probationary workers were to lose their job, it would save roughly 0.1 of a percentage point from the annual U.S. Gross domestic product. So maybe not a big savings there. This, of course, is according to the chief economist who served under the Biden administration, so certainly has the viewpoint there. So there you go. That's where CNBC looks on it. We're not seeing any major issues on unemployment at this time, but we are seeing the highest level we've seen in a week since the first week of the year. If labor does in fact break, that'd be one of those things that pushes rates down. Not great for the overall economy, though, and we'll continue obviously to watch that. One thing I also think about just in hiring in general, it's something that we're big proponents on with both of my companies, with BAM, with the team, is this statement right here, that this couldn't be more true. Hiring a new person is more work. Sometimes I'll put sometimes in there. This isn't my tweet. This is Jason Kalkanis from the All In podcast. Hiring a new person is more work than using AI to make the existing team faster. There is a lot of truth in that. And getting current team now doesn't mean that this is what that quote or that tweet doesn't say. Doesn't mean don't hire people, don't expand, don't invest in your business, just use AI and do everything and wear a million different hats. No, it's the team that you have can become way more efficient, can work a lot faster by investing in the right AI tools, by training in them, by getting dirty with them, by understanding them as the leader. All of that is 100% true. And I do think that the businesses that get it are going to lean into those investments more so than just job postings on Indeed. Indeed, we have a very good piece of news to finish this week off with. 4.271 on the 10-year treasury. If we look on the 3-month cycle, we're nearing 3-month lows on the 10-year, certainly not at a 6-month low, but we are at a 1-month low on the 10-year treasury. 4.269 is trending in the right direction to support maybe another move down today on the 30-year fix, where yesterday we came in at 6.78. These are right at or at about 4-month lows on the 30-year fix heading into the weekend. This is really good news for buyers who may be locking in today or tomorrow before the weekend, because what we've seen on some of these sharp declines in the past, just in August, we see a sharp decline down to 6.34, right? Where we were at 691 and then we were at 691 in August. I'm just using this as an example on July 25th. And then by August 5th, just like a week and a half later, we're at 634. But then what did we see? By August 8th, we were right back to 6.63. So when these drops happen, these meaningful drops like we've had right now, they could be a real opportunity that may not be here forever. I'm hopeful that it's going to be here for the foreseeable future and we continue to move down, but they just may not be, in that buyers certainly that are in the market right now, understanding that is obviously to their benefit when it comes to the financial affordability of the loan. All right. Love to see you guys join us inside the community at bamxschool.com/BAMX, where you get access to all of the week's hot sheet data, as well as in the classroom tab, you get access to whatever is new this week. We released done for you content templates, as well as video and email scripts. The email script this last week right here, I sent out to about a 40,000 email list for my team in Connecticut, and we had a 30% open rate and a great click-through rate on that. I don't have the click-through rate top of my head, but a 30% open rate beats industry standards, which is 15 to 18%. This content inside of BAMX, done for you content, is working. Go to school.com/BAMX. You get access to all of our events. Yesterday, if you missed the live role play that I did, don't worry. Tuesday at 9 a.m., I'll be doing another live role play for members right inside of BAMX. And you also get access to things like the Zudelio cash offer platform. That's a $2,400 annual value in its of itself, where you can make cash offers, bring 4 offers to each one of your sellers. School.com/BAMX. Join today, as we are planning a price increase in the near future. So make sure you join today. School.com/BAMX. All price levels are grandfathered for life of your membership. All right. Have a great week, everybody. That is your hot sheet here for the week. There will be a walkthrough podcast later on today on the channel here. And tomorrow I'll be doing a new Knowledge Brokers podcast over on Knowledge Brokers. Hope to see you guys there on some of those pods. Have a great day. Have a great weekend. We'll see you back Monday, 9:30 on the East, 6:30 on the West. Until then, of course, toodaloo.